Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock or recommendation. Them's the rules we have to work with. So in this episode of the Moneymakers podcast, I am talking to Dan Higgins, who is the fund manager for the Majedie Investment Trust, which changed its management approach just over 2 years ago now to adopted a new, what it calls liquid endowment strategy. We'll get into what that means again shortly. But since then, I think it's fair to say the performance of the trust has been pretty good in terms of the returns that you've achieved, a combination of the discount coming in quite notably, and also some steady NAV performance. So that's all good news. But of course, every week brings a new change in the international outlook at the moment. And we are all learning to live with Trump 2.0. So I thought I might kick off, Dan, by just asking you what your reaction has been to the arrival of the Trump administration. And it's, I don't know, I struggle to find the right adjective to describe the way that they've behaved so far. But it's certainly not been particularly coherent, I think one can say.
I think that is a fair starting assessment, yes. I think we were all expecting the Trump administration to be eventful, but I don't think any of us had anticipated the kind of onslaught of policy announcements that we've seen in recent weeks. And clearly, this administration cares a lot less about the equity markets than the first Trump administration did as a gauge of its success. But ultimately, I think the administration will have to respect the bond markets and the currency markets, and that may ultimately be the main restraining factor, as well as the reality that there are midterm elections in about 18 months in the US. So yeah, it's been an extraordinary period. And I think in the 25 years or so that I've been managing money, I've had to navigate a few financial crises, but this one is unique in so much as it's neither systemic nor is the proximate cause external. This one has been largely self-imposed, and that makes it different to the others in terms of how one contends with it, the challenges it presents, but also the opportunities that this, like every other crisis, throws up.
Indeed. I mean, I can't remember any period like this for the reasons you've just said. This is very different in kind to the kind of crisis we've had before. And of course, it's still playing out. And as many people have commented, it's created this climate of uncertainty. Nobody quite knows. Well, they know in broad terms what I think Mr. Trump is trying to achieve, but they don't know how long he's going to go on pursuing it in this rather cavalier fashion, where everything seems to change from one day to the next. I mean, this week we've had him being really rude about the chairman of the Fed, and then the next day saying he does not intend to fire him before his term expires. But who knows what he'll be saying tomorrow. But I think certainly it does seem the case that the bond market is, and perhaps the currency market to this extent, we've seen bond yields higher than they would otherwise have been and the dollar coming down, which is an unusual combination. So I guess one says that as you survey the field, you're hoping that, if you like, the kind of institutional realities will restrain this administration from going completely off the rails before it's done. So
I think that's our hope. I think what makes it challenging for all investors is that, first of all, one has to try to quantify the first order effects of, we'll talk about tariffs first, but specifically the first order effects of tariffs. What impact will they have on economies, individual companies, the terms of trade? And the truth is, none of us really know, including, I suspect, the people within the administration themselves. And then you have to try to calibrate the second order effects. And by that, I mean, to what extent will the policies and the manner in which they're delivered affect confidence? Most obviously in the US, consumer confidence within boardrooms, capital expenditures. I mean, it's just so hard for companies to plan and invest when they don't know what the playing field will look like. And then the third aspect, as you rightly point out, Jonathan, that makes it really hard is the policies might change tomorrow. So as an allocator, trying to decide what return you require to compensate you for taking risk and the cost of capital for different companies and investments, it's very hard. It's shifting the whole time.
Do you, though, have any sympathy for the argument that says that the US has been building up a whole series of problems over the last few years in terms of it's running a massive budget deficit? It is obviously experiencing a significant trade deficit. And its public spending certainly appears to be far outstripping the capacity to fund it with taxation in the longer term. So I guess you could argue that to some extent, the fact that we've now got Trump and he's been elected in part as a result of the consequences of allowing those things to develop, that in a way he's just brought forward perhaps a crunch point in any event where the rubber was going to hit the road at some point.
Yeah, look, I think the confounding thing about Donald Trump is that there's quite often a kernel of truth to a lot of what he says and does. His instincts, in my opinion, are generally speaking pretty good. And I think that's why he has such popular appeal. Personally, I have some doubts about whether his views on trade deficits are necessarily right, as to whether it's necessarily an unhealthy thing to run a deficit with another country if you do want to be the world's reserve currency. And I also have some questions about the apparent belief within the administration that tariffs are not inflationary. The monetarist argument that if something costs a consumer a bit more, they'll just spend less money on something else, and the money supply is everything. I'm not sure whether I agree with that view of the world either. But frankly, what I think doesn't matter. These are the policies that they've decided to pursue. Now, I hope and increasingly believe that the way in which they're going about pursuing their agenda might actually be the long overdue catalyst for some really positive things to happen, not just in financial markets, but in the world more generally. So the immediate consequence of the very, very public castigation of Zelensky was that a lot of European countries within days got their act together, committed 800 billion euros to defense spending, and that Germany got approval to move way above its historically very conservative fiscal position. And I think that a lot of companies and businesses will be questioning whether America is as much of a trusted partner as it has been historically, and that may revitalize the prospects of companies and industries in other parts of the world. So in many ways, and I never would have expected it to happen this way, I think the rather troubling events on the world stage in recent months could actually lead us to a much healthier and better and more balanced place, both economically, politically, and societally than we'd previously been in.
Would it be fair to say, though, that, I mean, I think it's come to a shock to quite a lot of people, the way that the new administration has behaved, certainly with reference back to the way that the markets reacted to the likely and then actual election of Trump in the autumn last year. There did seem to be a surge of adrenaline that went through the financial markets. We talk about interest rates coming down, taxes coming down, equities doing very well, and so on. It's been quite a rude awakening in that sense. To that extent, has it been a disappointment to you as well, compared to where you were at the end of last year?
No, I don't think it has been a disappointment. If anything, our competitive spirits left us feeling a little bit left behind in the immediate kind of euphoric period that you mentioned, because we didn't own a lot of the obvious Trump trades. We didn't own AI related momentum stocks, and we don't own Bitcoin, and we weren't willing to own other shares purely based on what people assumed would be the new administration's policy agenda. And the good news for us, and the reason I think that we feel we're pretty well positioned for the current environment, is that we felt the regime was already shifting, and everything we've seen and heard in recent months has really just accelerated that. So a couple of months ago, I gave a presentation to Majedie shareholders, which was titled "It Ain't Necessarily So." And the general gist of the presentation was that although I think most allocators and investors recognize that the world has changed since COVID, that we can no longer assume that we are in a world of ever falling interest rates and rising markets and low levels of dispersion and low inflation, low prosperity. I think most people recognize that that's changed, that most allocators and investors' behavior was still very consistent with what worked in the old regime, that their muscle memory was strong enough that the things they invested in and were allocating capital to were actually the things that wouldn't necessarily do very well in a new regime. So to us, most obviously, we question the assumption that the US market always outperforms other markets. And we question the assumption that a small number of stocks always drives returns. There's an argument that active management doesn't really work very well because it's impossible to find the good companies at reasonable valuations. And if you just own the entire index, you're guaranteed to own the winners. Well, the stats don't actually bear that out. There have been 3 periods in history in which a small number of stocks has outperformed an equal weighted index. We've just been in one of them, and we questioned in our presentation whether that would continue. We questioned whether the dollar always goes up. I've been doing this long enough to remember that if you had invested in the US stock market, in the S&P 500, at the very bottom of the market after the dot-com bubble burst. If you'd invested in the market between then and the peak of the S&P 500 ahead of the financial crisis in 2007, the market nearly doubled over that period, but the US dollar went down about 30% over the same period. It went from around 155 to 2 to the pound. So a large proportion of your gains in the US equity market as a sterling-based unhedged investor would have been wiped out. And this, again, I think has just become a working assumption for many investors that will always be the case, and we question whether it would do. So I mention all this because our inclination has been to look for the best risk-adjusted return opportunities away from the obvious areas where large amounts of capital have been channeled. And those happen to be the momentum areas where a lot of the greatest pain and existential risk comes from everything that we've been talking about. So just to give you one more statistic, since 2009, since the global financial crisis, the net international investment position, in other words, how much capital of other countries invested in the US, less how much has the US invested overseas, that number has gone from minus $2.3 trillion to $23 trillion. Ironically, the US has been a huge beneficiary of foreign capital inflows over the same period that the Trump administration believes that, based on trade surpluses and deficits, that other countries have been taking advantage of America. And in order for there to be a meaningful reversal into the sorts of areas where we have a lot of our investments, you don't need to see that entire trend reverse. You just need foreign allocators to invest a bit less into the States and for some of that capital to find its way into other areas. And you could see a really big and structural shift in what's working in financial markets. So we were already positioned for that. Arguably, we were a bit too early, but it means that we haven't had to make huge adjustments to our portfolio as a result of everything that's been going on over the last few months.
Yes, I was going to come on to that. I think it does seem clear, at least so far, there's been a significant move away from dollar-based assets generally. And we've also seen a significant rise in the price of gold as well. Before we talk about the rest of your portfolio, does gold play a part in your liquid endowment strategy or not? And if not, why not, I suppose one could ask.
So it doesn't, for a couple of reasons. So when we talk about the liquid endowment model, the endowment part of it for us is that we want to own productive assets. We're very fundamental, we're very long-term. Equities lie at the heart of our approach, and we believe that ultimately that's the asset class through which one is most likely to compound wealth over time. And we're very fundamental, and we seek to buy those assets at a discount to their intrinsic value, to the net present value of future cash flows that will accrue to their owners. And we're willing to embrace differentiated and sometimes alternative sources of return in order to do that. So that's the endowment part. It reflects the mindset that has served elite university endowments very well over a very long period of time. But we don't own anything that's illiquid, hence the liquid part of liquid endowments. So we don't do venture capital or private equity or real estate or private credit or infrastructure. But we also don't own any assets that have low return expectations or are solely there for diversification purposes. So that's the first reason we don't own gold, is it doesn't have a cash flow. And I don't know, therefore, what the net present value of that asset is to someone who owns it today. I completely understand the role that it's supposed to perform in a portfolio. And if it's ever going to work, now is the environment in which it should work. But the second reason we don't own it is we will not own anything that is predicated on a particular view of the world playing out. So we use volatility and macro uncertainty to make really good long-term investments, but we'll never come to our shareholders and say, well, we're really sorry, we thought that the dollar was going up or down, or that inflation was going to be 5% rather than 3%, and that's why we lost you money. We're investors. And there are people who have different skill sets than ours and kind of tactical asset allocation or owning an asset like gold because of the role it is intended to perform in a portfolio. That's not our strength.
Well, that's a very interesting point. I think perhaps it might be worth just elaborating on that, because I think a number of listeners might find that a little strange in a way, because it sort of implies that you've got no view about where things are actually going in the short term or even medium term. But the basis on which you're therefore picking things has to be some kind of fundamental value, but that in turn is obviously based on some expectations and assumptions. So to some extent, you are still in that game, are you not? Otherwise, you wouldn't be able to do anything particularly.
It's a subtle but important difference. So we will never own something that is predicated on a particular version of the future playing out in the way we may think it will. We are naturally attracted to investments where we believe that the probability of future outcomes is not reflected in today's prices. And very often it is macro uncertainty or other external imponderables that create that opportunity for us where we can buy an asset at a discount to what we think is probable or the cash flows that are going to accrue to us in a base case scenario. But we know one thing, and that is that we cannot predict the future. And I think it was Keynes who said, if the facts change, I change my mind. So when we make investments, we do so based on reasonable central case assumptions. And if those assumptions change or look like they're going to be completely wrong, then we will change our minds. But we would much rather own something with a margin of safety based on central case assumptions than we would own something because we think a particular view of the world is going to play out. So currency is a really good example of that. And I know opinions differ on this meaningfully, but I know I do not have an ability to consistently predict the direction of currencies. And as a sterling-based investor, if I'm owning an asset that is denominated in a currency other than pound sterling, I'm effectively taking two views. The first is I think the asset is going to go up in local currency terms. And the second is that the currency in which it's denominated is not going to depreciate materially against the pound. And I do want to take the first bet. I don't want to take the second. So our default positioning for Majedie, with the exception of special investments, and we can come back to remind listeners about our three types of investments. With the exception of special investments, we typically eliminate or mitigate the possibility of currency fluctuations by hedging currency back into pound sterling. So Majedie's shareholders can think of it as a sterling-based asset, and we will never use currency moves as an excuse for losing them money.
Or as an explanation for not making money, presumably, as well.
Correct. Look, we think we're good at three things. And those three things are, by way of reminder, we identify and access a small number of what we believe to be truly exceptional third-party managers who invest in equities and sometimes credit, and they tend to be specialists in niche and structurally inefficient areas. So we have allocations to a software specialist and a Japan small cap activist and a China A-shares specialist and an international equity manager who specializes in companies that have private equity backing, and then to managers who specialize in stressed and distressed debt. So we are trying to access the skills of truly elite managers who specialize in inefficient niches. And that component of our portfolio is about 60% of the total, and we rather unimaginatively call it the external managers allocation. The second part of the portfolio we call direct investments. And again, as the name suggests, we own a small number, currently around 10, direct holdings in public equities that must meet certain quality and growth criteria. And we tend to look very much off the beaten path. So the stocks that we own are, generally speaking, not household names. And they are increasingly found in Europe and the UK, because again, that's where the momentum has not been. It's where expectations are lower, and we think fundamentals can improve on the upside. And the third part of our portfolio is special investments. A few times each year, we are given the opportunity to invest alongside some of the world's great investors in their highest conviction ideas. These may be thematic opportunities, but more often they are co-investments in individual securities that they feel particularly strongly about. And usually we can invest in those on pretty attractive terms. Return requirements are higher for those. And put them all together, and you get a very eclectic mix with equities at its heart, with underlying investments that are not very correlated to one another. All of them, I should say, are independently priced on a pretty frequent basis. So there's no question around whether Majedie's net asset value is a real net asset value. And because the sources of return are very different, we believe the portfolio is worth more than its constituent parts. So those are the things we do want to give our shareholders exposure to, and we're very happy to stand or fall on the performance of those investments. But as you say, we will never use external variables as an excuse for either underperformance or having failed to participate in a particular opportunity.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So as you look around for these opportunities, how do you decide how much to allocate to each of these different strategies? Because obviously you can say, well, they're all doing what they're setting out to do, but at some point you have got to make some kind of decision about the amount you have in each of them. And that is based on what? What's driving that particular decision-making framework?
So there is a framework, and we've given shareholders a broad sense of how they should expect the allocations to look over time. So the external manager component will always be the single largest part of the portfolio. It's currently 60. I think that's probably as high as it's likely to go. It probably won't ever be much lower than 50%. The two bits that tend to change a bit more, and they're somewhat fungible, are the direct investments and the special investments. So the special investments component is entirely opportunity led. Because our bar is so high, we will not look at a special investment unless we feel that it can deliver at least 20% annualized returns. And that is a very ambitious target. We turn down 4 or 5 of these opportunities for every one that we invest in, and we're only looking at things that are potentially interesting to us. So if there have been 1 or 2 sources of frustration for us over the couple of years that we've now been managing Majedie, it's that we've struggled to get the special investments allocation up to the 20% initial target that we'd hoped. And that's partly been because the bar is very high, and it's partly because money has come back to us from certain opportunities faster than we had thought. And so the direct investment part of the portfolio tends to be the kind of solving element there. That's currently around 15-20% of the portfolio. But if special investments go up, I think you'd probably expect the other two to go down. I should also say we've had a fair amount of cash in the portfolio in recent months. And the reason for that is that historically, Majedie has had a debenture, which originally was taken out 25 years or so ago. And when it comes to structural leverage, I subscribe to Warren Buffett's view that if you're good, you don't need it. And if you're bad, you certainly shouldn't be using it. We just don't feel that leverage is required in order to deliver the sorts of inflation-beating returns that we're looking for. So at the end of March, very recently, we paid off that debenture in full. And that will save Majedie's shareholders around 100 basis points a year in interest costs. So now we've paid that off. And the timing was obviously pretty good given the dislocations in markets. We didn't go into April with debenture funding in place. We'll now be pretty close to fully invested most of the time, whilst always maintaining a good degree of liquidity in the portfolio. So that's the kind of broad framework. And then in terms of individual positions and how we size them, there's a pretty simple equation or formula. The numerator is our conviction level based on our experience and quantitative work and research. Just how strongly do we feel about an investment and its return potential? And then we will adjust sizing based on a combination of expected volatility, expected liquidity, and correlation, both to markets generally and to other investments within the portfolio. So in theory, the largest investment should be something that we feel very strongly about. It's very liquid, it's not very volatile, and it's not correlated to anything else we own. That's the kind of holy grail for us, but we'll size things up bigger if they have those attributes.
So your sort of public target is to beat the CPI by 4% per annum over a 5-year period. With inflation around 3%, should we say, that's around 7% per annum. Obviously, it may not stay that way. But in there, you've got these things that you hope or believe are going to make 20% per annum. So you're basically balancing those with more boring stuff that isn't actually going to make those kind of returns, presumably. Is that right? I mean, I accept that 4% over CPI is the minimum you're looking for, but you're not actually hoping to achieve 20% per annum over the whole portfolio, presumably.
So your logic is impeccable, but the conclusion slightly different to our own. So if one's objective is to beat inflation by, let's say, 4% annualized over a rolling 5-year period, I think there are 2 ways in which you can try to do it. The first is to find a collection of assets each of which you think is capable of doing that. And you have to have a very high degree of confidence that they will achieve it. It's really hard, in my opinion, to do that if you don't believe your strength is predicting the future or owning assets that are predicated on a particular view of the world. So our way of doing it is to put together a collection of assets which have largely independent return sources to one another, each of which you know is capable of doing a lot better than inflation plus 4, but knowing that they won't all work, and they certainly won't all work at the same time. It's a bit like proverbial peloton in a cycle race, that some will be working when others are not. And to our mind, that's a much more durable, repeatable way of doing it. So there is no investment in our portfolio today that I do not believe is capable of generating 8% returns. We actually just took a little bit out of the specialist credit area, which has done rather well for us over the last 12 to 18 months, because spreads on credit and high yield bonds in particular are now very tight. So one of the peculiarities of recent weeks is that as yields on longer dated government bonds came down, spreads on high yield bonds went out, even though the yield on many high yield bonds didn't go up materially. But they've come back in again. And we think that the risk or the return one is getting to compensate you for credit risk in certain parts of the market has deteriorated to the extent that your best case scenario is you make 7 or 8%. And that's not enough for us. So we've taken a bit of money out of that area. And now the lowest return expectation we have for any of our investments is 8 or 10%. And on the continuum, at the upper end, we have investments that we think are capable of generating a multiple return on capital. Put them all together, we think we have a very good chance of beating the CPI plus 4 target. And as you have correctly deduced privately, we think we can do an awful lot better than that.
Well, that is still quite an ambitious target, therefore, and particularly in this environment where things are going all over the place. You say, obviously, you do a lot of effort into looking at correlations and so on. Have those correlations held up in the most recent 3-4 month period? In other words, was your analysis correct, even though some other correlations have broken down, as you've already mentioned, that are commonly used by market participants?
So at the risk of going too far down a rabbit hole for your listeners, by and large, they've held up, and there have been a couple of exceptions. So as I mentioned a little while ago, our portfolio is skewed away from the US. So US equities make up about 2/3 of the global indices. They make up just over 1/3 of our portfolio. Most of the equities we own, directly or indirectly, are internationally listed. We have steered clear of mega cap stocks, which make up a large part of the indices. So we have a bias towards mid cap stocks. And then we also have a meaningful exposure to specialist credit strategies, including stress and distressed debt. So by and large, in recent months, these investments have performed exactly as we would have anticipated. They have been uncorrelated both to one another and to markets more generally. And the one exception is in a couple of areas. The 30% of the portfolio that's in US equities has definitely proved quite correlated in the recent sell-off, which is fairly typical of indiscriminate kind of panic-led sell-off in markets. We think that creates opportunity in those investments. So although we think the market's been a bit irrational over the short term, it's kind of investors have sold first and asked questions later. We're very confident that those investments will prove uncorrelated over a sensible time period, let's say months, if not years, but over a period of days and weeks, they've certainly been somewhat correlated.
So it's fair to say, I mean, I should have mentioned this before, I guess, that the last 2 years, 2023, you made an NAV total return of 14%, and in 2024, 21%. So you've been doing pretty well, at least against your target, very well against your target, but obviously less well, perhaps, for some of that period for the US equity market. So that's all been good. You also have a secondary ambition, which is to grow the trust. You've made that very clear last time we spoke, and you're still quite small in terms of market cap. Less than 150 million, I think. So you need to get back to a premium before you can really think about doing that, unless you happen to persuade some other trust to give you their assets. And the discount has come in. So how do you explain that? Is that down to the performance only, or how much is it down to bringing new shareholders onto the register? I know that was another ambition of yours. What's actually been the experience so far?
I think it's a bit of both. So first of all, the share price is what matters. We're shareholders in Majedie, and ultimately it's all very well the NAV doing well, but it's the share price that we all own. And incidentally, the board of Majedie when we were appointed, were insistent, and they were quite right, that we earn our fee on market cap, not net asset value, because that's what shareholders are exposed to. So it is pleasing to see that during a period in which we've performed pretty solidly, the discount to net asset value has come in materially. And I attribute that to a couple of things. First of all, yes, we have brought new shareholders onto the register, who include a couple of Oxford colleges, family offices, wealth managers, and individuals. And it is our job to get the message across and continue to bring new shareholders onto the register in order to support the share price and, in due course, hopefully fulfill our ambitions of growing the trust. But the second reason I think that the discount has narrowed is that increasingly allocators of all types recognize that in order to deliver good inflation-beating returns over the medium term, you're going to have to find investments that are different, that are off the beaten track, because you and I are having this conversation at a time when equity markets still look pretty expensive. The equity risk premium is negligible. And so there's no particular reason to expect that just owning the market is going to deliver good inflation-beating returns over time. It's going to be absolutely critical to find the best investments, avoid the duds. And that's what we do. And so I think a combination of having a differentiated way of investing, being able to offer people something that they can't get elsewhere, is perfectly suited towards the investment trust format, that there's no big question mark about the pricing of our portfolio because we don't invest in highly levered strategies or strategies that are hard to value or price, and that it feels like it's relevant and pertinent to the world we're now in. I think all of those things have contributed to a growing interest in what we do.
I would say as an observation that reading your annual report and looking at the documents, there's obviously a significant amount of disclosure in there, more than you get from some other of your peers in the flexible investment space. But you do, to some extent, also have the same problem, do you not? In that, by definition, these funds, for example, that you employ are ones that no one's ever heard of. So, in a sense, it's difficult to analyze exactly what they're doing or how well they're performing. I think you give a summary of their relative contributions, but I don't think you actually strip out, unless I missed it, the individual performances over each period. Do you do that or not?
In our quarterly reports, we give attribution by subcategory. We comment on the major contributors, the kind of main winners and losers within each category, and we give disclosure both in the quarterly report and complete transparency in the annual report as to the holdings themselves. But your point is well made, and we are as transparent as we can possibly be, primarily because we're not insecure about sharing with shareholders what we're doing. I think that many of the investments we make would be very hard to replicate. So transparency and communication are critically important, and we'll continue to improve on that.
Yeah, so my only point about that was it's just, well, as with all kind of investments, I suppose, managed by a third party, there's an element of trust me about it, in the sense that you're the ones who are making those detailed allocations and looking at those detailed correlations. And that, I guess, is what you would say you're paying for. But I'm just wondering how far of a barrier that might be to persuading more investors to come on board.
I hear you. To be candid, the only limitation from our point of view is when we ourselves are subject to non-disclosure agreements or confidentiality agreements about the underlying sources of return. If we allocate to a manager, they provide us with very good transparency, but we have to be respectful and sensitive of sharing that information publicly. When we make special investments, we quite often initially use these rather cryptic project names. That's not because we're trying to obfuscate, it is because we're under an NDA, and the fact that a manager we know is involved in an activist situation and has yet to disclose a stake may in itself be sensitive information. But our intention is to be as transparent as possible, whilst of course treating all shareholders the same and fairly, and we want to do everything we can to let shareholders know where their money is invested. It is their money, after all.
I think my final point about that is just simply to say that obviously you are investing in some quite recherche things. You've got credit and you are doing global equities and individual equities and different countries and Asia and Europe and US. Now, you would think that would require a very large team of people to do it. So how do you actually find the resources to keep on top of all these very different strategies that you're pursuing?
Well, first of all, what we do is differentiated, but it is not complex or arcane or exotic. So we don't do exotic derivatives or levered strategies or complex trading strategies. We're fairly simple and straightforward in our approach. We're very much believers that over time markets reflect fundamentals, and the majority of Majedie's portfolio is invested in equities and credit instruments. So it's not complex or exotic in any shape or form. The really nice thing about the way we manage money is, although our team is fairly small, we're 12 people at our firm, there are literally hundreds, if not thousands, of some of the world's best investors all peddling away under the surface, trying to add value for our shareholders. This combination of a small number of directly held investments in public equities with funds that are managed by teams of experts in specific areas is a really powerful one. It's arguably the most active form of active management. And our job in that respect is to monitor the managers, not to second guess them on every investment that they're making. The same is true of special investments. Our job is to evaluate the credibility of whoever has brought the idea to us, must be a trusted source, to form a view on whether their thesis is credible, and then test it. It is not to originate deals ourselves or try to second guess the managers. So, yeah, the labor intensive bit is to monitor and test and evaluate. And we have a team of really good people doing that. And then we use a lot of quantitative tools to help us get to the answers pretty quickly. And I know we've got this far in the conversation without mentioning it, but it's extraordinary the extent to which AI and those tools are making that job easier, like every day. I think it's a real leveler for a firm like ours in terms of helping us get to the answers quicker and more effectively.
Well, can you just give us a rough idea then of what you mean by that? In what areas is it helping in terms of scanning documents or actually looking at correlations and things like that? Where's the bulk of the added value coming from?
We use various risk systems, many of which we've built ourselves, but some of which are off the shelf. And the off the shelf ones are now invariably incorporating some form of AI or something they call AI into their platforms. So for all of our external managers, for example, we get really good transparency reports. We're now using a third-party system where the managers send the exposure directly to the third party, and the third party produces incredibly detailed exposure and attribution data on the managers we allocate to. And with AI now integrated into those systems, we can plot changes in exposures very quickly. We can set up alerts so that if a manager were to make a dramatic change in country exposure or a largest position or to change a view on something, it would ping up on a screen and our analysts can then apply their subjective judgment to that rather than spending their time actually entering the data. But then the other area is just in using productivity tools like Perplexity or ChatGPT to enable us to go into a meeting much, much better informed. So we recently had a meeting with a biotech manager, and we were able to ask really targeted questions about their thesis on individual names because we could ask ChatGPT using its deep research function to do that for us. So in my experience, at least so far, AI doesn't give you the answers, but it helps you ask the right questions and target them much more effectively. And it just saves a lot of time. So it's early days and we're all still learning. And then there are just really basic things like note taking in meetings and production of client reports and so on that are also making all of our lives easier.
So you probably started your career building spreadsheets, did you, back in the day?
Yes.
I'm not doing that now, at least not doing it by hand as many of us used to do back in the day.
No, it's all changed. But it's funny how certain things come full circle. The reason I think we enjoy what we do so much is that ultimately investing, it's not a calculating exercise. It's really important to be able to do the numbers, but one is trying to form an informed view on cash flows and then the discount rate one should apply to those cash flows to know whether you're buying an asset at a discount to its intrinsic value. And I think we're now in a world where markets are just as inefficient as they were when I started out in the early 1990s. Again, I've already paraphrased or quoted Warren Buffett once in this conversation, but I think Warren Buffett actually misquoted his mentor, Benjamin Graham, who said that in the short term, the market is a voting machine and in the long term, it's a weighing machine. I absolutely believe that still to be the case. But I think in many ways, it's become a digital voting machine that on any given day, markets are up or down and share prices are up or down, not because something profound has changed in the actual value of a company, but because an algorithm or a dark trading pool or a momentum investor or someone who just got fired at a levered pod shop is being forced to sell something. And that is what creates inefficiency and opportunity for people like us. And there have been periods over the last 5-10 years in which I think we've all questioned whether that actually works anymore. And everything we've been talking about in this conversation makes me feel more positive and confident that it can work. No one would be an apologist for all active managers. In aggregate, as an industry, it's almost self-evident that active managers will not add value. But I think the opportunity for the best active managers to add value is better today than it's been, certainly since we started our firm 12 years ago. And my final thought on this is, with respect to equities particularly, one has to ask why you are investing in equities. If your purpose when investing in equities is to deliver really attractive inflation-beating absolute returns over time, I think the best active managers are by far your best way of doing that today. If your purpose when investing in equities is to beat an index, which is increasingly arbitrary and lopsided and expensive, well, then you need to probably find some other way of doing it. But I think this could be a great period for the best active managers to add values, and our job is to go find them.
Well, that's a very good note on which to end. The striking affirmation of the value of active management after a period when active management has perhaps not done as well as many would have wanted it to, for many different reasons. Yeah. Well, let's hope that you're right, and I look forward to hearing from you again in a few months' time and see how you've managed to navigate this particular period that's coming up with all the volatility that we've been talking about and uncertainty we've been talking about. So that was Dan Higgins, the lead manager of the Majedie Investment Trust, talking to me on the 23rd of April.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.